Welcome, everybody, to the Chinchilla Picking Podcast. It is June the 24th, 2022. And as always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. Good evening. My name is David Underwood, and I am here with Brandon Beaver. Brandon, how are you doing, man?
I'm doing all right. I'm a little tired right now, but the room I'm in right now has like barely any air conditioning. It's really annoying. I'm really hot right now, but I'll get through it. It'll be all right.
Good. I'm really tired of all these extreme heats for June, man. You know, it's going to be a little much.
Yeah, it was 95 degrees the other day.
I mean, we get 90s here in Cincinnati, but we usually get it in July or August, September. We don't usually get it in June. So it's been a little hotter earlier than usual.
My AC in my car can't keep up with what it's too hot, and Shepard Smith is on CNBC at noon and him and his eyeliner, man. Get him and his eyeliner off of my TV. I'm turning on CNBC for business news. I understand the importance of Roe versus Wade. I get the importance. I get the significant importance of it. I understand. Okay, that's for Fox News. It's for MSNBC. It's not for CNBC. I'm looking at business news. We had a monster rally today compared to what we've had. We had okay, so tell me why we're having a rally. What is behind this? All day today, it's about abortions.
Yeah, and I understand that, you know, even if you're a business news site, you got to report on the big events. So do a report and then move on to business news. You know, have it at, you know, I don't know. It's a huge event. So once an hour, spend a couple minutes and then move on to business news because that's what we're watching for. That's what we want to know about. What's moving the markets? Why is this bank moving this way? Why is that company moving this way? You know, that what's the latest reports out today? You know, I mean, come on. We want the petroleum report. We want to know that. We want to know what's going on with the, you know, we're going to get the GDP report next week, you know, and if that's negative, then we're technically in a recession by the definition. So, I mean, that's the stuff we want to know. We don't want to know about, you know.
I don't want to see some guy that could have played Dracula in a 1920 silent movie with all of his eyeliner running because he's crying about politics. I want to watch business news.
Exactly. And there was a good amount of business news today. I mean, here, let me just read off some of the headlines here that you could have, if you were, you know, wanting to just cover the news, you could have just covered just these things here. We have Apple's ready to bargain with its first store to unionize, right?
Yeah.
Well, IMF, the International Monetary Fund slashes U.S. growth forecast. He's narrowing path to avoid recession. You know, Northrop and Raytheon win key hypersonic defense contracts. Here is Chevron to relocate head office within California and sell the existing headquarters. Yeah, I mean, there's just a lot here. Moody's reaffirms United States rating at AAA, which I don't think they should, but you know, I understand their reason for doing it. But I mean, look, I'm just reading off some headlines of things you could have talked about. Yeah. There's lots of things going on today. There always is. But
Raytheon's getting close to a buy again.
What is it?
Raytheon. Both Raytheon and Lockheed Martin's, we called them buys last year because we were looking at this whole situation with Russia playing out, and then potentially even situations with China. And those have given up a lot of their gains in the past year. I think Raytheon's only up 8%. Lockheed Martin's somewhere around the same.
Well, I mean, now we have to have a hypersonic missile because China and Russia have a hypersonic missile. So who's going to win in that? Raytheon and Northrop Grumman, because there's the ones who are going to pay for it or build it.
That one's L3X. Lockheed Martin LMT, Raytheon RTX. The symbols on the stock market, of course.
We actually weren't meant to be covering those right now. This is just a sidestep too.
Yeah, but and I'm going to go a little bit further with it too, because JP Morgan put out an interesting article, and they're kind of being like the one bank that stands alone in this point of view, where they're saying that there's a good possibility that the United States will escape a recession this year, and that investors have priced in catastrophe, and that when we don't get the catastrophe, stocks will rip back upwards and we're poised for a great second half. Part of their thesis here with their foreign policy analysis is that Russia and Ukraine will enter into a ceasefire. Now, if that happens, we will get a rip your face off rally, because too many people have put, like, everybody's put so much importance on the Russia-Ukraine thing. We're not getting Russia oil back. That's not going to happen. But the initial positive reaction to a ceasefire, especially when it comes to the price of wheat and things like that, come out of Ukraine, it will rip your face off. We will get a nice rally off of that if that happens. We've started to see some dominoes of inflation fall. We're seeing steep tech discounts. Oils came back down again. I don't know how sustainable that is, but it has come back down again. I think some of the speculation has tapered off, and that's the reason why we've given back some of the gains that we've had in oil. That's not a bad thing. So for right now, from what I'm looking at, I'm starting to see the potential that inflation has peaked.
Okay, so I got a number of things to say to that.
I took you on
I really do. I want to just go off here, but we're gonna do it point by point. But first, guys, Brandon jumped the gun here. I have to tell everybody the rules, Brandon. The rules. Brandon and I get together 5 to 10 minutes before the show. We tell each other what we're going to talk about. You hear the live discussion here on the show. We save it for you. If you like what you hear, go ahead and hit subscribe, follow us, and let us know what you like about it. DM us, follow us on Stock Twits. We're on there as well. All right. What you just said about inflation. Number one, I want to tackle that timeline thing, because last week on the show, I said that I'm looking at October as a possible time that the stock market turns around. And I said there's a 3 to 6 month lag with Main Street versus the stock market.
Yeah.
So, and I believe that we are technically in a recession. I believe that it's going to be a shorter, shallow one. And I believe that the best possible case is we're looking at October as a boom turnaround point. That's the point when we start to move up, and it's going to be more of a V or a U, and we'll go right back up to where we were before in just a matter of months. So I agree with that standpoint there. But JP Morgan, I believe, is wrong in that we are not going to be in a recession. The GDP number next week should point that out, that we had a negative GDP for this past quarter, and thus we actually had 2 quarters straight of negative GDP, which is a recession. So I believe that we are technically in a recession, and the numbers will show that next week. That's why last week I also said that I'm about 4 to 5 weeks out from being fully invested, because I'm buying slowly every week as things stay low. You never call the bottom. I can never call the bottom. I tried to call the bottom on Instagram on Riot when it was at like 580, and it went down to below 5, and now it's back up to hit 580 today. So I mean, it's back up, but I mean, like, you can never really call the bottom. I use that as an example of, I just have found the time that I wanted to start accumulating a bigger position in that company. And it's just, I think that, we need to be still accumulating positions. I don't think you see an end right now. Like I said, I don't see the full turnaround until October. I say you use this time right now to accumulate positions in strong companies. I still maintain that view and maintain that.
And then if the off chance next week's GDP numbers come in positive somehow, they probably won't, but if they do, oh man, that's going to be a wild ride up. Because
I don't know if it'd be a wild ride up, but it should make markets move up.
Nobody's expecting it, though. We've all priced in the end of the world. I mean, not today. We rallied back up, but I mean, like, it was like catastrophic there for a little bit. Like we were seeing COVID lows when the economy was shut down on some stocks. So it is. I think if we're not in recession and GDP comes back positive next week, which it probably won't, but if it does, I think we're going to have a huge rally.
So here's how I know we're starting to bottom out, or if we've already bottomed out and it's already past that point of buying in at the exact bottom is I see all these 20, 19, 18-year-old TikTokers over there talking about, oh man, crypto's going down. It's going down to zero. I'm like, oh man, if they're saying, if every single one of them is sitting on there and posting on their phones and saying it's going down to zero, that's my time. I want to buy some of that because
they're panicking.
if they're all saying it, they're all wrong.
Yeah.
That's typically what you see because the everyday person, I mean, right now, look, I'm not going to sit here and try to push crypto right now because I think it's a risky buy right now, but I think Bitcoin would be a safe buy at these levels, very safe buy at these levels because it's going to go back up to at least over 30, maybe even 40. And what I'm saying is that when you see all these retail people getting on their TikToks or their YouTubes or their Instagrams and saying, oh, this is why it's a bear market now and we're all going down 4 months after the move has already happened, that tells me that they're finally starting to buy in that it's a bear market. And, it's too late by that point when all the masses are.
It's they've all went from thinking they were going to get rich overnight to being Peter Schiff.
Yeah. And I bet you $20, half of them don't know who Peter Schiff is.
I'm sure half the people that listen to this don't know, but that's okay. They're still educated. It's just, I'm a nerd. But Peter Schiff, he sells gold, right? And I'll say he's an economist. But yes. and a lot of the things he says make sense, but he's selling gold. So when he's so bearish on Bitcoin, which by the way, people forget for the past 5 years, it's up 800% still. It's not like it's like the worst thing in the world. It's not like it's going to zero anytime soon. In my opinion, it did predict inflation. It's just that when inflation happened, people took the profits in a sell the news kind of event. That's my opinion on and it did it better than gold, but we'll see if it continues to hold up. But his knocking on Bitcoin is constantly it's happening because Bitcoin is a competitor to gold and he sells gold. That's his business. So he wants you to buy gold, obviously, and not Bitcoin. But anyways, I got off track there, Dave. We're
talking about the YouTubers and the retail traders getting on all their TikToks.
So I just speaking of the YouTubers and TikTokers and Twitters, and going into FedEx's earnings yesterday, I was watching a bunch of people just get at each other, go at each other's throats about whether or not FedEx was double topping or whether it was a double bottom or whether it was a falling wedge pattern.
Hold on. Was it a triple shot extra foam ice macchiato? Because guys, I'm sorry, this is a pet peeve of mine. You cannot outthink the market. You are not smarter than the market. You cannot say, oh, I know this kind of chart pattern is going to be the XY flutter B wing. You buy low, you sell high. It's simple.
But in fact, the fundamentals will work themselves out. I will say this: double tops and double bottoms sometimes do play out, and so does a triple bottom, which is a bad thing. And I'm fairly familiar with these kind of charts that they were all arguing about. They were all there, which is the craziest thing too, because this tells you how charting can be very unreliable. It was a falling wedge. It was a double bottom and it was a double top all at the same time. But what overrules all that is it was trading at a 0.6 price to sales ratio. And then so the company reports earnings. They upped their guidance, which surprised everybody to the upside. They increased their dividend by 58%, but they missed revenue by, I think, $0.1 billion or something like that. So there's a little bit of a miss on the top line there. But
yeah, but I mean, look at the economic situation right now. It's okay to miss revenue as long as you're making the adjustments right now. We understand it. We get it. We're like, okay, everybody's going to have a little bit of a miss in revenue right now, but can you maintain that bottom number? Can you show that you're effective leaders and effectively run a company and maintain that bottom number and show, okay, here's how we're going to come out of this good?
It was their pricing power that did it. So revenue, I'm going to just quote directly from the conference call here from their chief customer officer. Revenue management actions drove our growth, which was partially offset by lower shipment demand. So there was lower demand there. FedEx Ground and FedEx Express generated year-over-year revenue growth of 4% and 6% respectively, despite lower volume revenue. So the pricing, they have pricing power. That's what kept them up. And we've talked about, you go into an inflationary environment, you want a company that has pricing power. This company also adjusted their earnings per share for fiscal year 2023 of $22.50 to $24.50. So it's quite the gain there on their projected growth for EPS. They revised their guidance upwards. And the FactSet consensus was actually FactSet was expecting them to lower their guidance to $22.21. So they actually increased it. So they're expecting some growth there coming into the end of 2023 as well, or going into 2023. Doesn't look like they're looking for a recession either.
All right. So everybody's
quarter one, and they did say that quarter one that COVID had some effect on that as well at the very beginning of their lower demand.
Now, look, a lot of these CEOs and board of directors have a lot more information than I do. And I get it that they're not looking for a recession, quote unquote, and they probably are seeing things in the economy that I can't see. They could buy things.
It could also be that whatever they expect to happen here in the United States might be offset by China or whatever Asia businesses they're dealing with. So,
I mean, that could be it, but as well. But my point I'm getting to, Brandon, is the fact that everybody has had lower revenue recently.
Yeah.
And so that it continued into the second quarter. And by definition, a recession is just 2 straight quarters of negative GDP, which I believe we're going to have.
I agree.
And so that means that, yes, it could be just the 2 straight quarters. And then Q3 of this year, we start to come out of it. We may not have a stellar positive GDP of 6.5% or something, maybe like 1% or 0.5, but it's going to be positive. And, I believe that that's what's going to drive us. And then when October comes around and hits because of that news, the market's going to take off and really, really, really rally back up to where it was. That's why I said you're going to see a U or a V. If we see a U, that means we're pretty much at the bottoms now, and we're just going to stay here up and down, hanging around the trenches until we get that catalyst, that numbers, those reports in, and it shoots us up.
Yeah. Well, listen, if you bought FedEx when I told you to buy it, not just last week, but a couple weeks ago, whenever it was, I think I said to buy it around $200 and you made your 20%. So I took my gains yesterday after the earnings report was released. I made about 13%, 13%, somewhere around there. So with that being said, if you take your gains, go ahead. There's never any shame. Dave, you said this the other day to me on text. There's never any shame in taking gains. If those GDP numbers come back next week and they are negative, and they probably will be, and it will show us in a recession, most likely, FedEx will take a tumble. It'll be one of the first companies to take a tumble. So that's why I took my gains. Would
it be a good buying opportunity at that moment?
For sure. Yeah. It's because it's even right now, like if we were looking at smooth sailing economically, I would have held it. And I would still be recommending buying it right now if it wasn't for the potential of this recession. So yeah.
I'm so glad there's one of us on the show that is actually getting his calls right and actually doing things well right now, Brandon. And that's you, because I just cannot call anything to save my life right now.
I called to buy Meta when it was in the 230s. Okay. And that was my original. And here's the most important part. Like we've talked about having the dry powder aside, my cost average is down to 182 now. So I did not call the bottom on that, but I'm still comfortable with it, and just a little bit on the subject. There's a difference between cost averaging down rationally and catching a knife. People always say you're catching, don't go catching the knife, right? if you're cost averaging down rationally, you're buying a company that has had no material change in value of itself. And it's just been hit really, really hard because the expectation of a change in material value that you don't think is actually going to pan out. So right now, for me, yes, there's in Meta, there is for sure heavy competition with TikTok, right? But they have Reels, and Reels is gonna, I think, materialize very positively. Facebook, people look at it like it's it's just all for the old people. The young people don't care about it now, but they overlook the fact that Instagram is still the most popular app for young people, and it's owned by Facebook.
Yeah,
So,
and not to mention that how many big corporations came out and said that they are opening up metaverse shops where you could buy stuff online in the past month. Nike said they have a metaverse shop. I could go in there and get my Nike shirt for my avatar as I whirl around the whole metaverse.
yeah. So, and I do believe in the future of the metaverse. Right now, nobody's in the mood to speculate about anything, so they're not pricing it in. But if it pans out the way that we expect it to pan out, then the stock's going to go right back up. So I am not concerned with a 182 average on Facebook right now. I am prepared to buy more on Dibs at some point. It's not my next stock on my list. I've also added more to Activision. I'm continuously accumulating that while it's near 20% below where it's going to get bought out at. So Activision,
You're building positions in companies you believe in right now, which is what we've been saying. It's what we've been saying for about a month.
First time I bought SPY since pre-COVID. I don't think I bought it during COVID. I may have played calls on it coming back up, but I don't think I even bought SPY then. I think I was individually picking stocks. Now I went for SPY. Let me tell you why though. Okay, because it's a little bit of a different reason than what most people would. I bought Zim.
Hey, can you, before you go into it, can you explain what SPY is for those who may not know?
S&P 500 ETF with a very low expense ratio, which means that you're paying very low management fees to get into it. It doesn't track the S&P 500 exactly, but it's very close to it. So you're basically just buying the S&P 500. But it's as an exchange traded fund. So you're doing it through the stock market. And the ticker is SPY. And I bought Zim, the shipping company, which has been just a wild ride ever since I bought it. I was up and down and up and down. I'd be up like 10%, down 10%, down 15%, whatever. That thing was like having havoc on my portfolio, even though I still think it's a value. And I found myself looking at my phone every day, looking at it, what's happening today. And so I decided to buy SPY to kind of bring down my beta a little bit and bring down my my volatility, kind of anchor myself to the S&P 500 a little bit. So, if you're like me, you work 50 to 60 hours a week, you can't really be checking your phone all the time. So it lowered my volatility, allowed me to keep my position. So
I am not like you. I can check my phone every now and then.
Yeah, you're lucky.
Yeah, and SPY, you said that TD Ameritrade would allow you to trade it all hours of the day, Monday through Friday.
24/5, 24 hours a day, 5 days a week. And it was also good. I wouldn't just go out and buy. I wouldn't go out and buy anything just because I wanted to lower my volatility. I bought it because it was a good price. It's a good value.
And that's what we're looking for in this market. Good values, good companies that have that good price profit margins on their goods. So there you go, man.
I'm up 5.91%.
Oh,
not
damn. Look at Brandon killing it while everybody else is like saying, sell, it's awful market. The hell is falling down from the sky and fires everywhere. And Brandon's over here like, I just made 5 to 10% again.
That's when you buy. That's when you buy. When everybody's running for the streets, when there's blood in the streets, that's when you buy.
Right. I mean, we say that, but it's hard for people to do it because we've been saying that for about 3-4 weeks now, around there, saying, hey, start building positions, slowly build your positions. People, and you even said that people would think that you're crazy buying right now, but that's just it, because they're not the ones who are making money. Most people, 90% of people who try to retail trade will end up losing in the first year.
Yeah.
That's a stat I just made up right now, but it's probably right. It's probably true. And
I think it's 75% in the first 6 months.
see, there you go. And it's because you don't really understand how everything works yet, and you're still trying to figure it out. And that's why we say paper trade for a little bit, slowly dip your toes in the water and build your positions, man.
Yeah.
Cool. What else you got, Brandon?
Did I mention Elon Musk yet? We kind of went on a little trip there.
We did go on a trip. We have not mentioned Elon
Okay.
Musk yet this show.
So Elon,
we have mentioned him many times.
Elon says so he was at a Miami investment conference called All In, which, God, that name just drives me insane already. Like, I feel like I would hate everybody there. No offense if you went there and you listened to the show. I love you. No offense. But anyways, he said we're already in a recession, he thinks, and it could last a year to 18 months. And then he says recessions are not necessarily a bad thing. I've been through a few of them. What tends to happen if you have a boom that goes on too long, you get a mislocation of capital. It starts raining money on fools. He's right. He's totally right about that. It seems like he's read a little bit on the Austrian business cycle theory, which is just essentially that, but that these booms and busts are driven by central banks and federal reserves, which I subscribe to that theory. But I mean, he might be right, but I don't think it's going to be a year to 18 months though. You were talking about the stress tests, right? At least earlier, personally, we were talking about the stress tests, and all the big banks passed them.
Thanks for stealing my thunder here. Thanks for stealing my thunder. That was one of the things I was going to bring up. It's fine. No. Go ahead. Yes, so all the big banks passed them.
You mentioned that Bank of America had a little bit worse of a time and all that, but the big banks did pass. So this doesn't look like it's going to be anything like 2008.
No.
It doesn't look like it's going to be anything like that. The housing crisis that we all lived through. And it seems to me that's what people were pricing in. So as soon as it turns out to not be another 2008, the stock market, you mentioned it, I've mentioned it, the stock market increases, it goes back up, it recovers before the actual economy does. That's when it's going to happen. That's when the stock market's going to go back up, when we realize it's not as bad as we thought. Go ahead, Dave.
Yeah, and so a couple things here, man. Look, I agree with Elon Musk that we are in a recession. I do not agree with this timeline, and I do agree that times of recessions are good for weeding out weaker companies who are not financially stable and need to readjust. Those are all good things that could come from a bad thing, right?
Yeah.
So you try to find a silver line in those items. However, yes, the banks did have stress tests this week. The U.S. government put stress tests on the banks every so often. Thank you, Brandon, for bringing that up. They did. It had nothing but good news to say about all the banks. Bank of America was the worst performing, and even them, they would only have about a 2% decrease in earnings per share, and they would have to just maintain their dividends, not go up, and quit and stop buybacks, and all the banks would be just fine. And so that tells me, like you said, it's not going to be deep on the banks now. My concern is with individuals, Brandon, because when I talk to a lot of individuals have, they have all these personal loan programs, like through a firm and through other things, buying things they really don't need, and they've overextended their capacity. But household debt is keeps going up to historic levels. The U.S. American consumer has been really resilient to this since 2009, that our household debt has gone up and up and up consistently, and everybody's like, well, we could just keep going higher, right? Well, eventually it's got to stop. Eventually it's got to hit a ceiling somewhere, at least a ceiling for a short period of time, so that wages can catch up with the household income debt. But I'm concerned about the individuals. The big banks will be fine, yes, but individuals, no. Smaller businesses that aren't quite well capitalized, they would hurt, maybe disappear. Stitch Fix, I believe, was one that they were cutting massive amounts of layoffs, and they were saying all kinds of bad news. They may be one that disappears if they can't get their stuff back in line. There's a lot of other companies that aren't well organized that might go away. I mean, we're talking before. I mean, I can't talk about it on the show about certain companies, but there's certain companies, certain industries that are losing major parts of market share, and it's not looking good for them. they might have to cut back and close down some stores. And there's a lot of bad that's going to happen in the next 3 months to companies that have not set themselves up to be successful, which is why I like a Walmart, because Walmart will be here on the other side doing just fine, is what I believe. If I'm going to buy a store or something with a storefront, I'm looking at a company like Walmart.
Yeah, go retail. As far as big box goes, and I said to not buy it back in January, but that was because it was too expensive and inflation hadn't been priced in yet. And now it is, and it still looks to me like they're going to hold on to a very, very tiny net margin through all this.
It's crazy, isn't it? How they do that?
Yeah,
They're
I thought they'd
so
be
well
negative.
run.
Target went negative.
Yeah,
for a little bit. They were negative for a little bit. They weren't making any money, and but Walmart was able to hold on to it. So if you got a company like that net margin may be small, but the volume makes up for it, then yeah, it'll come back. And the earnings will go up on it. So you might look at it right now, the price to earnings ratio on Walmart might look high, but the price to earnings may not look so high after the next one, after the next earnings. If they are able to have some sort of pricing power where they're able to increase prices a little bit, maintain that net margin, and then inflation starts to roll over, their profits will grow. So the earnings will go higher. So the price to earnings will look better. I agree about Walmart is basically what I'm trying to say in a roundabout way.
I get you. But you cover it from more of an analytical side point, and I go at it from a straight macro. I've always said,
I'm the roundabout way.
Yeah, I'm John Madden and you're Al Michaels. I'm like, oh, they just sell more than you spend. You're gonna make money, and Brandon breaks it down and gives you the stats and everything. That's my John Madden impression. If you haven't heard it yet on the show, but yeah. So as far as what Elon said at the conference, yeah, the economy and everything, we will come out the other side, but there will be more slowdown, and I think we need it, man. We need the U.S. consumer to slow down this pace of spending because they can't keep it up. Not when we have to create so many financial solutions in order to keep this going. At some point, it's going to hit a wall when you have to start creating more and more and more. And then we're going to start creating an Affirm Plus. That's for people who have overextended a firm. You could go through a payment plan through Affirm Plus now. You know what I mean? It's like, where does it end?
Yeah, it's not good. And the thing is if people stop doing that and if people started saving, then we could actually, put a cap on inflation by ourselves. But that doesn't seem like that's going to happen. It'll be interesting to see what happens if we have a credit crunch. So yeah, those banks they're doing all right, but they're going to want to stay doing all right, So if we go into a recession and they start to get a little bit worried, then all of a sudden housing prices will come down, but it will be much harder to buy a house because you'll have to have that 650 credit score and 700. Right? Lately, the past couple of years, it didn't matter if you were sub 600; they would still make up for it. They'd find a way to get you in the house, even if your credit rating was in the 500 range. They would find a way to get you into it. That's not going to happen probably in the next year. So get your credit scores up. Pay down your credit card bills, and pay attention to those credit scores. Invest a little bit in yourself, and if we do enter in a recession, then maybe if you're looking for a house, then, if you've got great credit, then you could buy a house for a very low price rather than buying it, today, or if you bought it last year when the housing prices were at their all-time highs. So, yeah, that's just, I'm as concerned about the credit situation as you are. And I don't think people are thinking long term. I think it's all about now. It's all about the instant gratification. And that's not good. That's not good for society.
That's been a problem for American society for a while. American consumerism, materialism. You could go down the rabbit hole down there. We're not going to do that. We want to teach people how to make money, Brandon.
Yeah.
That's what we're all about here.
That's
so
part of it though. Right. Get your credit score in line. Have a nice savings account, and you can then you invest.
There you go, man.
And you can buy things, bigger houses with lower interest payments, nicer cars that won't break down on you like mine does right now. It has nothing to do with my finances. It's just my inability to ever get myself to buy a new car. I don't think I'll ever do it. I probably should, but yeah.
Cool. Final thoughts, man. Go ahead.
Yeah, I had one. Where'd it go?
I don't know. I have some. If you don't, I'll go into mine. I'll go into my final thoughts.
Go ahead.
All right. So here's my final thoughts, guys. Yes, we are in a recession. But there's some good and there's some bad for it. There's the good is the banks are going to look like they're going to be just fine if we do hit a recession. The stress test showed that they can withstand an economic downturn, similar to 2008. But they do have to make some changes. If they do that, they have to quit doing buybacks, flatten out the dividends. They got to make some adjustments, just like everybody should have to do if we get even worse times. But that gives us some hope. That means that we might be near a bottom here on the inflation, the recession. I believe that we are getting there. I believe that come October is when we should start seeing a return to stock market going up. This is just a guess. It may change as we get closer, but right now I'm looking at October as the GDP numbers coming in for Q3. I believe they're going to be going positive. If I'm wrong, that means we are in for that year and a half that Elon Musk is talking about recession. And, that's not really a good thing in the short term, but in the long term, you could continue to build your positions and grow and you're going to make money. Don't worry about it.
It doesn't look like it's going to be as bad as I thought it was going to be at the beginning of the year. And the rally today is not swaying me one way or another. Because I really don't know what to make of it. I don't know if that was short selling or short covering, or what it was today. I always kind of have a 2-day rule on it. If we have a big rally on it, just give it 2 days and we'll see if it's a short-term bottom that we've called and how the market's reacting then. But at the same time, I don't care that much. If I find a stock that is at value of a good company that I like, I will buy it and I will accumulate it over time, and odds are I will make money on it. So that's what I recommend everybody else doing. We can make these forecasts all day that the stock market might turn around by October. Historically, Dave's right about it, but you don't want to sit here and wait until October. That makes no sense. You want to start buying now and accumulating now. And Dave mentioned how you're not going to call a bottom. Sometimes you will, but it's not because you're skilled. It's mostly because you're lucky. So
true. So true.
Yeah. And I'll tell you what though, like me, I'm kind of like I contradict a lot, like not myself, but other people. Right. I am very like kind of against the grain kind of investor. That's just how I am. This bear market has been very boring. I thought I was going to get a lot more exciting deals by now. And like, I found myself some days staring at my phone, like, is this all you got? Come on, some more. I want Apple for like a PE of 10. Give it to me.
Right. You and everybody else.
Yeah. But they won't though, because that's the thing. Once Apple gets to a PE of 10, the whole world seems like it's burning and retail investors stay away.
Right. And it will. And also I think just to keep using the Apple analogy here, when Apple started dipping down, and it went down to like around 135, I think that's where 130, and then it's starting to move back up. I mean, it looks like it's stabilizing around 140, and it's hanging around that mark right now is where it seems to be hanging.
I don't know where I saw the price of it. I don't know where the 200-day simple moving average is, but it would be very interesting to see what that is, because that's usually where it hangs out at. It likes to go up and down. Every time I've traded Apple, it's because it's dipped below that 200-day moving average. I buy it and then I make money. And if I trade it, I sell it, they say not to trade Apple. You should own it. I actually recommend owning it, but I did trade it, positively quite a number of times, but okay. That's my final thought. I got there eventually.
Right. Hey, that's all that matters.
Yeah.
All right, guys. We hope you enjoyed the show. We hope you have a good night. As always, this is Chinchilla Picking. We hope we've been entertaining, educational, and uplifting, because we want everyone to make money. Have a good night.
Have a good night.